Yo, what's going on, everybody? My name is Ryan, and today I want to talk about 5 simple ways that you can do, 5 simple strategies you can do to reduce your taxable income and your taxable liability. So, just to kind of clear the air here, there's two main things that kind of go into the mechanics of the tax return that can lower your taxes. One is a reduction of your taxable income. These are, people call them deductions or write-offs. Yeah, they're all synonymous with each other. But yeah, one way is to reduce your taxable income. That way, the amount of taxes that you pay on your taxable income also gets reduced. And the other mechanic is the tax credit. Tax credits directly reduce your tax liability. So, it's not a reduction of your income, it's a reduction of your tax liability. Now, dollar for dollar, tax credits are worth a lot more than tax deductions, but also are much more limited in availability. So I'm gonna go through some of these right now. The first one is contributing to your HSA, your health savings account. Now, this is only available to you if you have a high deductible healthcare plan. HSA is basically an account that you can send money to and then use that money to pay for various medical expenses. The money that you contribute to your HSA is deductible, which means it will reduce your taxable income. Now, I think this is a good strategy because most people in America have some sort of medical expenses throughout the year, every year. Whether it's doctor visits or prescription pills or even over-the-counter pills, massage therapy, mental health therapy, acupuncture, all those things can count as a medical expense that qualify with the HSA. So that's why I think it's such a good thing to do if you have a high deductible plan. If you have a low deductible plan or no health insurance, then unfortunately you don't qualify for the HSA. And just keep in mind there are contribution limits every year that change. The next strategy is contributing to a 401k or an IRA. Both vehicles are very similar. The 401k is usually done through your employer, and this is, any money you contribute to your 401k actually does reduce your taxable income. Now, if it might not feel like that, okay, because you never see the money, it never hits your paycheck. If you do it through your employer, you just never see it, so you don't feel the difference, but it is reducing your taxable income. When you get your W-2, just look at your box 1 versus your box 3 on your W-2, and you're gonna see your box 1, your gross wages, is actually lower than your box 3 if you do contribute to your 401k. I also love this strategy too because you're not spending the money, you're not buying a thing for it, in which case might be like kind of a waste of money. You're saving it for your retirement, for your future self. So any growth in the 401k or IRA accounts will be also tax-free. So as your money grows, when it's invested, it grows tax-free, and then when it's available to you down the road, then you get to pull it out and use it. And now when you pull it out, you will be taxed on it because it was tax deductible to you when you contributed. That means when you withdraw, it will be taxable. The one downside about this is your money will be locked away until you're about 59 and a half years old, barring some exceptions, which I'm not going to go into today, but your money will be locked away. So be sure to plan accordingly for that, to make sure you only contribute to your 401k if you have the ability to do so, if you really have the ability to do so. All right, the next strategy here is the dependent care credit. Yeah, if you have kids and you send them to daycare or you have a nanny watch them throughout the year, those childcare expenses can be reported on your tax return and be claims. There's a calculation you go through and you get a tax credit for those expenses, which could sometimes be pretty significant, like a few $1,000s. And remember, a tax credit is a reduction of your tax liability. So a few $1,000s of a reduction of your taxes due could be pretty significant. Now there's 2 things here. One, you have to have earned income. Earned income is income that you get from a W-2 job or as an independent contractor. If you own a corporation and you don't have a W-2 from that corporation, that is not earned income, okay? And then 2, if you're married, and you both have to have earned income. Okay, so you have a stay-at-home parent and one spouse that works, then you won't qualify for the credits. And I guess there's a third thing. Third thing is there are income limitations too. So if you make too much money, you won't qualify for the credit. The fourth strategy, charitable donations. Charitable donations are great because you are helping other people. Ideally, you're donating to a charity for a cause that you believe in, not just to get the tax deduction, because if you're doing it just for the tax deduction, you are making a terrible financial choice. Because obviously you're reducing your income. Whatever money you contribute to charity, it reduces your taxable income. That means your taxes then are reduced as well, but your tax liability is a percentage of your taxable income. So, you donate $1 to charity, you might save like 20 cents on taxes. So it's not a good financial move in this case, but it's great if you have a cause or a charity you want to support, and you also may see a tax benefit from it. Another thing that people forget is that you have old stuff in your home that you donate to like Goodwill or ARC thrift stores or whatever. You can get a deduction on those. Just make sure you keep really good records and photos and stuff of the things you donate, because if you donate a lot of things, the IRS might get a little fishy on you and they might want to audit your donations. But yeah, goods and the old stuff you have can be donatable, and those donations can be tax deductible on your tax return. All right, and the last thing I'm going to talk about today, the last strategy, is interest and taxes paid that can be deductible. So if you own a house, your primary residence, your mortgage interest can be deductible up to a certain amount, and your real estate property taxes can also be deductible. Other taxes that can be deductible are state taxes, local taxes paid, sales tax, your vehicle taxes. All those things can be deductible, but there's a limit now on how much taxes you can deduct, and that limit is $10,000 of taxes that you can deduct on the Schedule A. But still, something to consider. Sometimes people make a car purchase, and the car purchase is pretty large, so they pay a lot of sales tax on that, and that sales tax can be deductible on your tax return. Income tax that you paid to the state throughout the year on your W-2 job, that can be deductible as well. So just really these things, maybe you've heard of it before, maybe you're kind of aware of it, but just know, I just wanted to give you a clear, hopefully a more clear picture of what can be deductible, what things you can do to help reduce your tax liability. All right, so that's all I got for today. Thanks for watching. I appreciate you. Be sure to hit the subscribe button and like this video if you found it helpful, and I'll see you next week.
I hit the function, hit the rose till I hiccup. I hit the stage and leave with money that say stick up. She picture perfect, so I told him I'm a flick up. Feel I'm in the mood for a change up. I leave the city and return with my change up.